Welcome back, everybody. Earnings season keeps giving us more surprises, but it seems like most of them have been surprises to the downside, as the market has cooled off a bit over the last week, especially in the tech and AI names. So in this video, we're going to talk about a few of the earnings reports from stocks in my portfolio, the three most critical numbers that I took away from what they reported, and why we shouldn't overreact to the price action on our stocks after earnings. So let's go ahead and get started. Now, first off, we're going to start with one of my favorite companies, and that is Cloudflare. Now, if you guys remember, I added Cloudflare last August, I think, and it's really been one of the funnest stocks in my portfolio. It's one that I just really felt strongly about. I actually use their developer platform for stock bites and all that. It's amazing. And what I loved about this report is that they are clearly a company that's on the rise. Now, in terms of what they reported revenue growth of 31% year over year, actual RPO year over year growth of 43%, and current RPO year over year growth of 30%. I think we've talked about what those are in the past, but basically RPO is remaining performance obligations. It kind of gives you an idea of what type of contracts and revenue they have coming up in the future. So for a SaaS company, it's just one of those metrics that we tend to look at to see how their business growth is looking kind of outside of this current quarter. But let's go ahead and get started with the three critical numbers that I saw for Cloudflare based on what I'm personally looking for. Now, the first one was obviously revenue growth because it grew to 31%. And if we just take a look real quick, we can see that the growth trend for Cloudflare is that it keeps trending up. So they've basically accelerated revenue growth since Q2 of 2025 and continued in Q3. But in addition to revenue, the RPO growth of 43% was also accelerated from the previous quarter where it was 39%. So basically what you're seeing there is you have revenue growth that's accelerating from the previous quarter. You have remaining performance obligations that are accelerating from the previous quarter. And I mean, that's just a good story. It means that you're getting more business into the company and the company's growing, at an accelerated rate than it was even a quarter ago. And if we just take a look at their earnings presentation, their dollar-based net retention chart this quarter is just beautiful. It's accelerating to 119%. And what dollar-based net retention means, it's like how much money you're getting from your existing customers. And when that number is over 100%, it means that, on a net basis, your customers are paying you more this quarter than they were last quarter. So in this case, it's 119%, which is obviously accelerated and better than it's been over the past 5 quarters or so. And so going back to what I said about Cloudflare at the beginning, this is clearly a company that's on the rise. And so those three critical numbers are revenue growth is accelerating to 31%, remaining performance obligations growth is accelerating to 43%, and dollar-based net retention is accelerating to 119%. And this is going to be a common theme that you see with the next two companies that we talk about as well. But look, at the end of the day, I want stocks in my portfolio that are growing and accelerating their growth, because to me, that is one of the best predictors of kind of outsized returns in the market. And that's because people like buying companies that are growing, and especially when they're accelerating that growth. To me, that's one of the best predictors of kind of future returns. Yes, there's always the valuation question. Yes, there's always what happens when growth kind of slows? And all those things have to be dealt with on an individual kind of company basis. But for Cloudflare, this was just an excellent quarter. I mean, all the numbers that I think are the most important are the ones that are not only good in terms of, revenue growth being over 30% in any kind of capacity is strong, but the fact that it's accelerating is even better. Now, in terms of the market's reaction to Cloudflare's earnings, I mean, it really kind of popped after earnings there, but then has basically come down with the rest of the market over the past week or so. And I mean, again, we're going to talk about this at the end. We don't need to read too much into what happens with the price after earnings. There's a whole bunch of reasons for that, and we'll touch on it because it affects basically all three companies that we're talking about. And next, let's talk about everyone's favorite stock, Palantir. I say that jokingly, of course. There's so many people that love Palantir. And then I told you in the previous video, anytime that I bring it up on this channel, people just lose their minds. They hate it, whatever. It's fine. And this is going to sound crazy because Palantir has been on a run of just crushing these earnings reports, and they crushed it again. I mean, when you look at their numbers and what they're doing, it is just unbelievable. And yes, I know the valuation's astronomical and all that, but you just have to appreciate what they're doing as a business right now. They're just phenomenal. So Palantir reported U.S. revenue growth of 77% year over year, 20% quarter over quarter. And when you break that down into U.S. commercial and U.S. government, so U.S. government, I think, is what people mostly know about Palantir, and it's up 52%. But Look at the U.S. commercial revenue. It grew 121% year over year and 29% quarter over quarter, which is just insane. And if we actually take a look at the newsletter that I pushed out last weekend, I talked about what I wanted to see from Palantir's earnings. And I've mentioned this multiple times, but the reason why I added Palantir even recently at their crazy valuation is very simple. I believe that the enterprise AI investment cycle is closer to the beginning than the end, and Palantir has no real competition in this space for what they do. So what I talked about I wanted to see was the enterprise AI growth numbers, specifically U.S. commercial revenue, which was up 93% last quarter. So what that means is that U.S. commercial revenue, again, was accelerating from 93% last quarter, which is unbelievable, by the way, to now 121%. And when you look at the breakdown, I mean, yes, we kind of know Palantir as like the government AI play, but that's at about a little under $500 million. But U.S. commercial revenue is growing rapidly in that space as well. And if we scroll down a little bit more, we can see that the U.S. commercial remaining deal value was actually up 199% year over year and 30% quarter over quarter. So the exciting thing for me is that, my main kind of investment thesis of buying Palantir at these levels after it had already kind of run up a bunch was that enterprise AI spending and investment is just starting, right? And Palantir, when it comes to operational AI, if you haven't watched my kind of Palantir deep dive video, I would recommend that you do that to kind of understand a little bit better kind of how they're different from a normal kind of data company. But the fact that U.S. commercial revenue grew 121% year over year and their remaining deal value is up 199% year over year, which is accelerating from the previous quarter, to me, that helps validate, at least up to this point, that my initial thesis is playing out. And we'll just see kind of what happens and if it continues and, of course, all that. But that's a very good sign, at least for me personally. And then lastly, if we go to the Palantir presentation, you guys might have heard of Rule of 40 before. It's kind of like a measure for specifically like SaaS companies where you take basically the revenue growth and the operating margin and you add them together. And basically if it's over 40, that means that it's a, fast growing and, profitable or efficient company that you want to invest in. And when you look at Palantir, their Rule of 40 score is 114%, up from 94% in the previous quarter. And as you can see, as you compare that to other companies in the market, Palantir is literally in a whole section by itself. Now, in terms of how the market reacted, Palantir was up, I think, in the after hour, all the way up to 220 or so, and then basically just came crashing down from there to where now it's, under 180 again. But for me, the three critical numbers for Palantir are pretty easy. One, U.S. commercial growth accelerating from 93% to 121%. U.S. commercial remaining deal value up 199% year over year. And then clearly, Rule of 40 score of 114%. To me, those are the three critical things that I took away from this quarter. I mean, honestly, you could have picked any number in that earnings report, and they were all fantastic in my opinion. But for my specific investment thesis in Palantir, it's enterprise AI. They have no competition. That's going to ramp up a lot over the next 1, 2, 3 years. And I think Palantir is going to be the biggest beneficiary of that. And at least up to now, for the most recent quarter, the numbers are saying the same thing. And one last thing I wanted to show you, just because it kind of shocked me when I first saw it. When you look at Palantir's revenue growth trend, it is just insane. I mean, look at this. This is from 2020, and this is a quarterly revenue growth trend. It kind of dipped here in, Q2 of 2023, and then it has just been straight up for the most part to where it's, 62% revenue growth. That is one heck of an acceleration, especially when you say, they were at like 12 or whatever in 2023. But this level of consistent growth is just pretty remarkable to me. That's just an amazing chart. But let's go ahead and get to Amazon. Now, Amazon, if you've watched this channel, we've talked about so many times. It's been my second largest position for I don't even know how long. So clearly it's a company that I think very highly of. I struggle sometimes to make videos on a kind of recurring basis where I'm talking about the same things in my thesis that we've already talked about so many times. And, I just don't think that stuff changes all that quickly, but they did have some nice numbers that we're going to take a look at now. Now, first of all, Amazon net sales increased 13%, which is actually accelerated from, I think, 11% a year before. And then, of course, the number that everyone cares about, AWS up 20% year over year to 33 billion, which, number one, is just a big number. I mean, obviously, they're the market leader, but 20% was accelerated from the previous quarter, which I think was like 17 and a half. And then even from the previous year where it was at about 19. So the big story is that AWS re-accelerating revenue growth, and that's a great thing. But the other part that I thought was really great is that if you look at some of their other business segments, they were accelerating as well, and specifically the high margin ones. So obviously we talked about AWS, which is the one everybody cares about, but their advertising services up 23.5% year over year, which actually was accelerating from the previous quarter where it was 22.9%, and third-party seller services up 12.2% year over year, which accelerated from the previous quarter where it was 11.5% year over year. And so look, I feel like I'm kind of like a broken record, right? I did say it's going to be a common theme for all these companies, but what you have is a story of re-acceleration, right? And for Amazon, it's a little bit of a different animal than, say, Cloudflare or even Palantir, because Amazon's much bigger, right? So their ability to re-accelerate growth is, much harder than a smaller company, let's say. Plus, because their revenue base is so high because of the retail stuff, it does make it hard to kind of re-accelerate the total revenue growth. So being able to see that at 13%, I thought was really cool. So in terms of what the market thought about Amazon's earnings, I mean, they loved it. It was at about 222 or so, jumped all the way up into the 250s, and then it's come back down a little bit as the broader market has come down. But, look, Amazon is one of those where it really hadn't been performing compared to some of its peers like year to date. And, now it has. And that's kind of a common theme. It's, basically people say just buy the Lag 7, any of the Mag 7 that's kind of down in terms of opinion and sentiment at the time, you should buy it, right? It happened to Google earlier in the year. It happened to Apple earlier in the year. It happened to Meta before. So, it's kind of that common theme of I still think these companies in general are some of the strongest in the market. Clearly, I mean, Amazon is a behemoth. I think it was kind of crazy where, just because it hadn't performed for this year, or I think even people brought out like the 5-year, performance charts. So just to recap, my 3 critical numbers for Amazon this quarter were revenue up 13% and accelerating, AWS up 20% plus and accelerating, and their high margin segments also accelerating in third-party services and their ad network. So clearly across the board, these 3 companies that are in my portfolio, the common theme is accelerating growth of the business, or at least of the key business segments, and in most cases of the business overall. So just real quick, I want to talk to you guys about earnings releases and price action and kind of how we should think about that whenever it happens. Because look, every single quarter you see companies report and you'll have someone say, hey, look, they beat on earnings, they beat on revenue, but the stock is down. I don't get it, right? And you have to understand something. The market is made up of a bunch of different people who have a bunch of different incentives and goals and methods to do all this. And the vast majority of activity that you see in the market every day is not long-term buy and hold investors who are buying a stock, holding it for a decade and saying, hey, look how good I did. Because the reality is that most market activity and market participants are traders trading or algorithms trading. And you just have to understand that they have different goals. They have different time horizons and incentives. And so it's not really going to necessarily mesh with what you think should happen anytime there's an earnings report. And what's interesting is that over the years, I've kind of learned kind of different methods of how people see things. And one thing that really stuck with me is that the chart a lot of times can kind of predict what's going to happen in the future to a certain extent, especially when it comes to be around earnings. And most of the time, whenever people are surprised at what a stock does after earnings, if you look back at the chart, it kind of told you ahead of time. And let me show you an example of what I mean. So this is the Duolingo chart, and you can see Duolingo, if we just go to the monthly real quick, like the Duolingo chart has been in a big downtrend since what is that, June? So, I mean, look, it's been almost straight down since June. But if you just go to the daily chart, what you can see is that right before earnings, they were right here at about 260 or so. And so if we just take a look at the technicals real quick, they basically close below the 8 EMA and below the 21, they're below the 200. I mean, this is basically a downtrend. And if we look at the MACD is like strong red. I mean, it's in a downtrend, and it's in a downtrend that's accelerating. And then if we zoom out to look at the weekly chart, what you would have saw is basically it was like right here, like the week before, right? I mean, this is, again, This is a downtrend, and this is a stock that has basically just been selling off. And at that point in time, if you looked at this chart and you saw this MACD, honestly, there's not much there from a technical perspective that would say, hey, this stock's going to go up. It'd be the opposite, actually. It'd be like, oh, this looks like it's going to keep going down just based on the technicals alone. Now, I know there's people out there that say, look, technicals are nonsense. You should stop looking at that. That doesn't mean anything. I disagree. I think on a short to medium term basis, and I've said this for a long time, technicals are a pretty decent kind of predictor or at least guide as to the probability of what's going to happen. It's not a guarantee. Everything's probabilities, but more often than not, it gives you a pretty decent idea. Now, over the long term, I still believe that good companies are the ones that go up the most, right? Still matters about fundamentals. It still matters about how the business is growing. Over the long term, that matters the most. However, short to medium term, including earnings responses, absolutely the technicals can show you something that you may not see. Now, that being said, there are obviously exceptions to this, and it usually revolves around anytime a company announces something that the market just doesn't expect, and that could be either good or bad. So if we go back to 2 weeks ago or last week, whenever it was, and you look at Fiserv, right? The market clearly did not expect the issues that Fiserv was having and that amount of uncertainty to basically be announced on that call. That's why, it might have already been in a downtrend, but that's why it dumped 40% in a day, because it was a surprise, right? And you get the opposite effect too, to where, a stock is really beat up, but they have something in earnings that's just new and material, or maybe there's an announcement that comes out that people didn't expect. And then whatever trend that's on the chart will actually reverse because the market got information that it didn't know, and it basically changed the overall sentiment of the company enough to basically move the technicals. And so my point in telling you this is not to convince you that you need to use technical analysis if you're not using it already. It's really just to give you some insight on, look, just because a stock moves a certain way after earnings, it doesn't necessarily mean anything at all in terms of the long-term potential of that company. And especially when you consider that the broader market can simply bring all stocks down as well. I mean, we saw what happened to the S&P 500 this week. So it was up here on Wednesday the 29th, and it's basically, been down ever since. And we'll see if it ends up coming back up. But the reality is that if the broader market is coming down, then basically most stocks are going to be impacted, right? There's always nuances and, different sectors and things that happen to do well when other sectors don't. But in general, you can have a stock that had a great quarter. Their long-term outlook is unchanged and very positive, but they may totally dump after earnings because that's what the market's doing right then, or that's what the technicals are saying, which is driving a lot of the trading behavior in spite of the fundamentals. So my main point in just bringing that up to you is just don't overreact to whatever happens in terms of price action after earnings. It doesn't really always mean anything. I think part of the challenge is that anytime a stock moves for any reason, everyone tries to explain it. Oh, AMD's down because, the AI trade is a bubble. Or now, no, AMD's up because they're the new winner in inference. And that's what the market is seeing. A lot of it is just traders are trading technicals, man, and it doesn't really mean anything. And what you have to watch is over the long term, the companies that do the best should also perform well from a stock price perspective. But on the short to medium term, a lot of the price action is going to be noise. And if you try to rationalize every single day of price action, you're going to drive yourself crazy, number one. And number two, it's probably not going to be very meaningful because I don't know that those things really mean much outside of what's happening in the market from a trading and a noise perspective. But anyway, hopefully you guys have had some stocks that have done well during earnings. And if a lot of you own Amazon, then, the answer is yes. But let me know how you're doing in terms of earnings in your portfolio overall. Mine has definitely come down over the past week from when I did my portfolio recap. But look, stocks go up and down. It's not a big deal. And yeah, let me know down in the comments how you guys are doing. And if you want to see my actual Palantir deep dive where I kind of talk about their business, why they're unique, and why I feel they don't really have any competition, you can watch that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom. So keep building and stacking wins. I'll see you on the next one. Peace.